Thank you. Thanks a lot, Andrew. This is incredible to be here. I have never given a talk in such a beautiful place. I should first apologize for the fact that my English sounds a lot like French, and I am. So at least for those of you who know French, maybe this will be familiar, and I hope others can still understand what I have to say. So this is going to be a talk about inequality, and I'm going to try to present some results from my book, but most importantly to draw perspective about the future. So this will be based on this book. I should say very clearly that this book, Capital on the 21st Century, comes from a very collective international research program. There's no way I could have collected all this historical data by myself, and I started working on the history of inequality in France about 15 years ago, and I was very fortunate to find many co-authors like Tony Atkinson, Emmanuel Saez, Gilles Postel-Vinet, and Andrew Lake, which you just heard, who extended this work to many more countries. And in this book, the main novelty is to try to put this historical material together in a consistent manner, which had never been done before because the historical data had not been collected, largely for bad reason. I think this historical data was viewed as too historical by economists who sometimes are only interested in the past 10 years, and it was viewed as too economic by historians. So in the end, nobody was really using it. And so this is what we have done together. So in this talk, I will try to present a number of selected historical evolutions coming from this work and attempt to draw lessons for the future. So if you want to know more about this database, you can go to this website, the World Wealth and Income Database. So the countries in red are already in the database, like Australia or France or the US, and countries in blue, like Russia or China or Brazil, are currently entering the database, largely because of the success of the book contributed to put pressure on governments to open some of their fiscal archives and financial data. And now we are able to access more data, in particular in a number of emerging countries, in countries like Brazil or Mexico, or countries like Korea or China were not in the database at the time I wrote the book, and now we are able to increase transparency about inequality, which I think is very important for the democratic debate in every country. So I'm not going to be able to talk about every country in this presentation. I will show a few results about Australia later, but if you want to know more about the database, please go to this website. So I'm going to try to make 3 points in this presentation. First point about income inequality. I will talk about the long run, what we know about the long run dynamics of income inequality. And here probably the main lesson will be that in the West, in the today's developed countries, it took major shocks in the 20th century following World War I, World War II, in particular the Great Depression, for the elite to accept the kind of fiscal and social reforms which in the end contributed to reduce inequality. But there was no spontaneous reduction of inequality going on pretty much until World War I and World War II, and this played a major role in the past, and this is something we need to be aware of. This doesn't mean that wars are the only way to reduce inequality, of course. Hopefully we can do better in the future, but it's important to have this historical record in mind in order to analyze the future. The second point will be about what I call in the book the return of a patrimonial or wealth-based society. And I will show you that wealth-to-income ratio, which measures the total amount, the total value of wealth, real estate, business assets, financial assets owned by individuals relative to annual income, that this has increased over time in recent decades. This corresponds to what I call the metamorphosis of capital, the transformation of the nature of capital rising real estate prices, of course, is a very important part, and I know this is important, of course, in Australia, but this also includes the rise of immaterial capital, stock market capitalization of companies, and this has implication for the future of wealth concentration as well, because this increasing quantity of wealth is very unequally distributed. Now, the third part of this presentation, to me, maybe the more important, and this is about inequality in developing countries and emerging countries. As I was saying, probably to me, the most important impact of the success of the book was to allow us collectively to access more data in emerging countries. And this is very important. One of the main limitations of my book, I should say there are many limitations in my book, although it's very long. I'm sorry it is so long. It's also because it covers a lot of historical data and it takes time to, it's a complicated story. Inequality is a complicated story, so you need a lot of pages to try to tell it all. But although it is long, it has a lot of limitations. And in particular, the most important limitation is clearly that my book is too much Western-centered. It puts too much an emphasis on Western Europe, North America, Japan, Australia, but basically the developed world. This is not entirely my fault. This is partly because of lack of access to good historical data in emerging countries and less developed countries. But to be honest, it's a bit more than that. It's also that this book is very much centered on the role played by these major shocks, World War I, World War II, on inequality, and this is something that's important, but viewed from Africa, viewed from Latin America, viewed from China, it doesn't have the same importance, these shocks, than what it has, of course, for Western Europe, but also North America or Japan or Australia. And I think it's important to move beyond this sort of Western-centered analysis of inequality. More data access is very important, and I will try in the last part of this presentation to show you a couple of results about what I call extreme inequality levels, because inequality is important in Western countries, but I think it's even more important in emerging countries where you sometimes see levels of inequality in countries like South Africa, Brazil, or actually the Middle East, which are much higher than what you see in any developed country. And I think this is an important part of the explanation for the social tension, beyond religious and ethnic conflict. I think inequality is one of the major sources of political conflict and instability, and that's very important to study in a broader perspective than just today's developed countries. So the kind of comparison I will make at the end will be to show how the Middle East today is probably not only more unequal than Western Europe or the US, but actually more unequal than South Africa and Brazil. So I will return at the end of my presentation to this kind of comparison and how we can analyze this kind of inequality level. But what I want to say is that my book and the first two parts of this presentation is very much centered on Western Europe, the US, and a little bit also Japan, Australia, but not as much as Western Europe and the US, unfortunately. But in a way, looking in a broader perspective, including South Africa, Brazil, the Middle East in the picture is to me, even more important. So let me come back to what I'm going to do. So I'm going to start with the first point, which will be about the long-run evolution of income inequality, in particular in today's developed countries. Then I will move to wealth. Then I will move to developing countries. So first point about the long-run dynamics of income inequality. So here, probably the most important conclusion, as I said, is the very big impact of the shocks of the 20th century, World War I, the Great Depression, World War II. If we want to understand the long-run reduction of inequality, it took really these very major shocks, and in the end, probably the most important conclusion is that political determinants of inequality are more important than the pure economic determinants. So by political determinants, I mean not only the war and the destruction going to the war, but most importantly, the transformation of the social policies, the fiscal systems, the education system that were influenced largely by these big shocks during the 20th century, but more generally which are influenced by the political process, the power of the different social groups and different ideology. If we want to understand the long-run evolution of income inequality, we really need to look at this. So let me start with one case which is particularly striking, which is the case of the United States. So this is the evolution of the share of total income in the US going to the top decile, which is the top 10% of the distribution. So if we had complete equality, the share of the top 10% in total income will be 10%. Okay, if we had complete equality, but nobody is thinking of having complete equality, but what we see in the real world is typically that the share going to the top 10% is between 30 and 50%. Well, sometimes in very equal country like Sweden, at some point in the 80s, they would have 20 to 25% for the top 10. And in very unequal country like South Africa or Brazil, we will see that it can be over 60% for the top 10. So this will be the variation. Now, you can see that for a given country, which is the US, it goes from 50 to 30 and then back to 50. So you have quite a spectacular evolution because for a long time, the main view about the long-run evolution of inequality was the so-called theory of the Kuznets curve. So Kuznets was an American economist, Ukrainian-born American economist who computed the first national accounts for the US in the interwar period, the first series for GDP, national income. And then he was also the first economist to use historical income tax data in order to compute the evolution of the share of national income going to the top 10%. And he wrote in the 1950s, and he came with a relatively good news, which was a reduction of inequality. And so we agree with Kuznets. He didn't have Excel, but he did all the computation right. So we have no disagreement with Kuznets. The only difference is that we have another half century of data. Okay, so he wrote in the 1950s, we write in 2010, 2015, and also we have 30 countries now in our database, and Kuznets has only one country. So this makes us come to different conclusions, and in particular, you can see that in the post-war era, you have a stabilization of inequality at a relatively low level, between 30 and 35% for the top 10, which means that the post-war decades where you had a sort of a balanced growth equilibrium, in the sense that if you have a stable share going to the top 10%, this means that everybody is going to benefit from growth at the same speed. So like in 1960 or 1970, if you have a growth rate of 2% or 3% per year, if you have a stable share for the top 10, it means that the average income of the top 10 is going to rise at 2%. The average income of the bottom 90 is going to rise at 2%. So, you have inequality, but everybody is going up at the same speed. So you have rich people, middle people, poor people, but, in a way it's okay because everybody is moving up, so it's a lot more acceptable. Whereas in the recent decades, starting around 1980, in particular with the rise of Reagan and the change in economic and social policies, although this is not the only factor, I will come back to this in a minute, you have a rise in the share going to the top decile, which is very significant. It is even more spectacular when you include capital gains, so capital gains is the income you make by selling typically stock options or equity on the stock market. So this is very cyclical. When you have a big stock market crisis, you don't make much capital gain. But then after the crisis, if you look at the last crisis in 2008, 2009, it starts increasing again, and in the end, in 2012, you have a level of inequality that is higher than in 2007, which was itself a little higher than 1928, right before the crisis of the 1930s. Okay? And so looking at this graph, many people thought in the US, and I think many people agree now in the US, that rising inequality in recent decades not only contributed to the stagnation of median household income and bottom half or even bottom 90% income in the US, but probably also contributed to rising household debt and therefore to fragilize the financial system, which in the end led to the crisis. So here we are talking, when you have such a big change in inequality, it's more than just a few people who are getting very rich. It has really macroeconomic significance when you have a transfer of 15% of national income from the bottom 90 to the top 10. especially because the growth rate were not that high between 1980 to 2012, about 1.5, 1.7% per year if you look at per capita GDP. So if you have a big part of that, more than 2/3 actually of the aggregate growth going to the top 10%, it's not clear that this is a good deal for the rest of the population. You have almost complete stagnation for the rest of the population. Now, what about other parts of the world, and in particular other developed countries? So in this presentation, I'm going to show you sometime annual series so that you can see the short-term crises, which are very important. And sometime I will show you decennial averages so that you can focus on the long-run evolution. So for instance, this graph, you have the same graph for the US, but decennial averages, and you have the same evolution for Europe. So you can see, so Europe, as you know, Europe is a complicated continent. So what I mean here by Europe is an average of Germany, France, Britain, Sweden, Italy. So it's not quite Europe, but it's a big part of Western Europe at least. And the evolutions are relatively close in the different European countries. What's interesting is that a century ago, Europe was actually more unequal than the US. If you take Europe or France in the Belle Epoque, until World War I, there was actually more inequality than in the US. Then there was a big reduction, even more than in the US, following World War I, World War II. And then you have an increase in the recent period, but much less strong than in the US. If you look now at Japan, which is the other part of the rich world, you have an evolution that is in between Europe and the US, but in a way closer to Europe. So the bottom line is that the evolution of inequality has not been the same everywhere. Okay? Now, if you consider Australia, Australia in many ways is closer to Europe or Japan than to the US, in the sense that the inequality levels historically have been closer, to Europe and the US, so relatively lower than, closer to Europe and to Japan, so relatively lower than in the US. But still, there's been an important rise in recent decades, so that in the end, according to well, actually, I have the graph here. If you look at Australia, you see that the level, so in 2013, which is the latest data point that we have for Australia, so this comes from the World Wealth and Income Database, and in the case of Australia, and also New Zealand, and also Indonesia, I should say, the work is done by Andrew Legg and a number of collaborators, applying the same methodologies that what we have done for other countries. And so the last data point in 2013, you see that this is the highest level of inequality since 1951. So to summarize, the different countries have different relation to inequality, and certainly Australia has a more egalitarian tradition and a more egalitarian culture than the United States, or of course than Brazil or South Africa. So it's a more egalitarian country historically, but relative to this tradition, the country has become much more unequal in recent decades, and indeed, this is the highest inequality level we find in more than half a century. So I think it's important to have this in mind. It's difficult to judge levels of inequality just by comparing very different countries together and just saying, Australia or France is less unequal than Brazil or South Africa or the US, so we should be happy about it. I think each country tends to locate itself more to its own national history, its own tradition and values about equality and inequality. And so, the historical comparison is at least as important as the cross-country comparison. Now, how can we explain these different evolutions of inequality in these different parts of the world? This one explanation that we sometimes hear among US economists is that this is all the consequence of globalization. So basically, because you have globalization in recent decades, with competition coming from China, coming from the labor force, the low-skill or medium-skill labor force of emerging countries entering the world labor market, this is putting pressure on workers in the West, in developed countries, and this is dragging down their wages, and this is what causes rising inequality, and there's nothing we can do about it because globalization is good for these countries and for the world, so we should not worry about it. I think this is a bit, this kind of explanation is a bit US-centered in a way. And, the US economists and US people in general tend to be a bit US-centered. And this is, the problem with this explanation, it's not that it's entirely wrong. I think globalization, of course, plays an important role, except that globalization also happened in Sweden, in Germany, in Japan, in Australia, in France, and you don't have the same level of inequality, and you don't have the same magnitude of the rise of inequality. So certainly, globalization is putting pressure everywhere on inequality, but then different countries, because they have different institutions, they have different educational systems, different social systems, different fiscal systems, they are able to counteract these trends to different extent. And so if we want to explain why inequality has increased so much in the US relative to other countries, we have to consider a mixture of reasons. Changing supply and demand for skill, race between education and technology. Globalization is important, but you also need to explain, maybe you also have more unequal access to skill in the US. In particular, we all know that you have very good top universities in the US, but the bottom half of the population or the bottom 90% of the population, not only they are not going to Harvard, but the kind of public education and community college they have access to, their quality has not improved that much in recent decades, especially as compared to the rise of very high skill university. You have also an unprecedented rise of top managerial compensation in the US, which is difficult to explain simply on the basis of education and productivity. I think it has a lot to do sometimes with the ability of top managers to put the right people in the right compensation committee, and so changing incentives, changing governance structure. Also, very large cuts in top income tax rate in the US have probably contributed to this huge increase in top managerial compensation, which has been strong everywhere, including in Australia or in France, but much stronger in the US. Falling minimum wage in the US also has been important. So whatever, people can disagree on the relative importance of the education factor, the minimum wage factor, the corporate governance, the fiscal factor. But I think everybody should agree that it's really this mixture of different institutions and policies that allow us to understand why different countries go through globalization in different ways, with different part of their population that is benefiting or not from globalization. So just to illustrate this is the evolution of the minimum wage in France and the US, and the simple conclusion, so this is measured in purchasing power parity, so you can sort of compare the level in euros and dollars. You have so right now in the US it's $7.2 per hour, it's over 10 in France, or between 9 and 10 euros. So some people in France believe that it's too high, and I don't want to comment on this, but I think in the US it's certainly too low. And in fact, it's quite striking to see, President Obama proposed to increase the minimum wage from $7.2 to $10, and this did not happen because Congress in the US did not want. But even if this had happened, this will just be back to the 1960s. If you take in purchasing power term, the minimum wage in the US was actually higher than $10 per hour in the late 1960s, and there was no more unemployment than today. Okay, so it's quite unusual to have a country which over a 50-year period have an absolute decline in the purchasing power of its lower wage. So this is not saying that just increasing again and again the minimum wage is going to solve all problems. You also need to raise the skills and the education of the bottom skill groups so that they can access higher productivity jobs. But it's really, I think, a combination of these policies that is important. So the big decline in the 80s, 90s corresponds to inflation. So if you have the minimum wage is frozen in nominal terms, you have 2-3% inflation per year, then you have an absolute decline. Then under Clinton and Obama, you have some little increase, but this does not compensate inflation since the Reagan years. Another illustration of what I mean by institution and different unequal access to education. So this is a graph. So this is in the US. So right now, actually this was measured for people who were in college 2008 to 2012. So this is really a few years ago. So this is the relation between parental income and the probability to go to college for children. And you see, this is quite extreme. You know, what you find is you have a straight line, and it's almost the first diagonal in the sense that when your parents are very poor, when you are in the bottom 10% of the distribution, as compared to when your parents are very rich, you go almost from a 0% probability to go to college to a 100%. Well, not quite. You know, when your parents are very poor, you still have a 20% chance to make it. And when your parents are very rich, you have a 95% chance to make it. So, you know, it doesn't go from 0 to 100, but almost. And I think this is very spectacular. This was found by my colleagues, Emmanuel Saez, Raj Shetty, using exhaustive administrative data, tax data, and university data for the United States. And I think this is important because this shows that, you know, sometimes there is a huge gap between the official discourse about meritocracy and equal opportunity, et cetera, and the reality of what we do. And I think it's important to increase transparency, not only about inequality in itself, but also about access to education, access to public services, who's paying what, who's accessing what public services, because otherwise we tell us fairy tales. You know, I think the elites in every country have a lot of imagination in order to justify inequality. And it's not only in the US. I can tell you in my own country, in France, you know, there's also a lot of hypocrisy among the elite. And you know, although we don't have universities with very high tuition, the system is supposed to be public with zero tuition, etc. In practice, the public money that you put in the very elitist schools can be 3-4 times higher per student than the public money that France is putting in the basic universities to which children with typically lower social origins tend to go to. And so in the end, the public policy tends to amplify inequality rather than to reduce it in some cases. So there's a lot of hypocrisy everywhere. It's not to say that, you know, one country is doing bad and the others are doing very well. What's important is to bring more transparency to study how these different policies can affect the long-run evolution of inequality. Now, let me move to my second point, which is about the long-run evolution of wealth. So far, I have talked mostly about income. Now I'm going to talk about wealth. So income is what you earn during a given year, in particular your labor income, but it can also include your capital income, the rent or interest or dividends that you get from your capital. Wealth is what you own. Now, of course, what you own, the inequality of wealth in a country is partly determined by the inequality of income. So everything I have said so far about inequality of income also has an impact on inequality of wealth. But for a given level of inequality of labor income, there are other factors that can have an impact on the inequality of wealth. And so here, the main point I want to make in this part of the presentation is, number one, there has been an increase in wealth-to-income ratio in rich countries in recent years. Part of the intuition is that in a slow-growth society, in particular with population stagnation and aging of the population, wealth accumulated in the past can naturally become very important. And in the very long run, this can be relevant for the entire world and not only for developed countries. This raises new policy challenges, new forms of property relation. The key role of the legal and political system is very important for different dimensions, in particular access to real estate for the young generation. But this also includes other issues such as the democratization of governance in companies, patent laws, which are much more important in societies with a very high wealth-to-income ratios than we have today than in previous decades. So let me go through very quickly through a number of graphs. First, if we look at the case of Europe, Germany, France, UK, you have a long-run increase in the wealth-to-income ratio starting after 1950. So today, in France or in the UK, the wealth-to-income ratio is between 5 and 6. What does it mean? 500 and 600%. This means that on average, If the average income is, say, 30,000 euros per year per adult, the average wealth will be 6 times 30,000 euros, so 180,000 euros. Now, in practice, of course, not everybody has exactly 6 years of income in wealth. You can compute your own ratio or look around you. You know, this varies a lot. But it's important to see how these ratios evolve at the level of a society taken as a whole before looking at the distribution in itself. Now, we should, of course, not be nostalgic about 1950 when the wealth-to-income ratio were very low, because this is simply because there was a lot of destruction during the war. And also, if you look at these three countries, because most of the saving between 1910 and 1950 was not invested to increase capital, but rather was lent to government, which used it to finance the war, which itself was destroying the rest of the capital stock. So, you know, which is a little bit stupid story, but this is the story of Europe during this period, I'm sorry to say. And also, finally, one of the reasons for the very low level of 1950 is less negative, has to do with the rise of new regulation, nationalization, rent control, which reduced the market value of capital, but did not reduce the quantity of capital. So it's important here we look at the market value, but the social value of capital can be different. So there are really many different forces that play a role in this graph, some positive, some negative, so to speak, which need to be taken into account. If we look at the evolution of the structure of capital in the very long run, we have a lot of historical data for Britain and for France. You see that agricultural land in the long run has disappeared, or it's still there, but the value of agricultural land is much less than before. So if you just stick to your agricultural estate, you cannot be very rich today. Real estate, housing, in particular urban housing, is much more important today. Other business capital includes, in particular, the stock market capitalization of company, business assets. Net foreign capital is what you own in the rest of the world, which was very important for Britain, of course, until the early 20th century, and part of what they own was in the rest of the world, other countries, including Australia, but mostly in a very different part of the world, the Suez Canal, or in South America, or in Africa, in other parts of the world. This disappeared after World War I and World War II and after the independence process. You have a similar evolution for France in the long run, except that it took more time for the agricultural sector to disappear in France, but in the very long run, you have very similar evolution. Now, if we look at the recent period, and now I'm going back to annual evolutions, and you can see that including in Australia, but more generally here, you have the top 8 developed countries in the world in terms of GDP level, US, Japan, Germany, France, UK, Italy, Canada, Australia. And you can see that in all of these countries, you have an increase in the wealth-to-income ratio over this period. Basically, every country had a wealth-to-income ratio of 2 to 3, or 2 to 3.5 in 1960. Now everybody's between 4 and 6, and this evolution has been actually continuing since 2010, in spite of the financial crisis. So you really have a long-run evolution, which is important to have in mind, because sometimes when you read economic textbook, you hear that the ratio of wealth to income should be constant, should be stable. So, be careful with economic textbooks. Sometimes in economics, when we don't know much about something, we just assume it's a constant, which, of course, if you have only one data point, everything is a constant. But when you have more historical series, in fact, it's not a constant. In fact, there's no reason it should be a constant. Let me make clear that even in the simplest sort of fairy tale economic model with one good, no relative price of real estate, of stock market, the ratio of wealth to income doesn't have to be a constant. It really all depends on how much you save and invest relatively to how fast you grow in terms of underlying population and productivity growth. And if you save more, for instance, because of aging and you want to accumulate more wealth because you want to prepare for the future, then you're going to have a higher wealth-to-income ratio. And there's nothing bad about this. Let me say very clearly that rising wealth-to-income ratio in itself is certainly not bad. If everybody has an equal share in a gigantic pension fund or in the real estate of the country, then where is the problem? It's not bad in itself. The problem is first that in practice you have a lot of inequality in wealth, and many people, in particular in the young generation, have problem accessing wealth because a big part of this evolution reflects a rising real estate price, which is something you know a lot about in Australia, but we know a lot about it in Paris. I can tell you, for the young generation who want to access real estate property, if you don't have family wealth, and you only have your labor income, this will have to be a very good labor income today as compared to what it was for the generation of your parents. So this has consequences. This has very concrete consequences. These are not just numbers. This has consequences for the life opportunities of different groups, and we need to take that into account. This also has consequences for financial regulation. You can see here the case of Spain, where the bubble, in particular the real estate bubble and stock market bubble, was even bigger than the Japanese one in 1990. And I think this kind of perspective can help to prevent this kind of crisis and make sure that we try to cool down the banking system and the real estate system before it is too late. Another part of the explanation for this evolution is the decline of public capital. So take the case of Italy. Italy is the black point, which is at the bottom of the graph at the end, at the top over there. This corresponds to a situation. So when you have a negative public capital for Italy at the end of the period, what does this mean? This means that even if you sell all the public assets, the public buildings, the schools, the hospitals, or the public financial assets owned by the government, which are quite small in the case of Italy, but which could be higher in a country with a big sovereign wealth fund. Even if you sell all these public assets, this will not be enough to reimburse your public debt. Okay, so this is what a negative public capital means. So over this period, these governments have increased their public debt, have reduced their public assets through privatization. So if you have less assets, more debt, you reduce your negative, your public capital, which also limits your ability to invest in infrastructure, invest in education, because it means, in the case of Italy, let me make clear, I'm not saying that the Italian government should sell all these public schools and hospitals, and many people will be shocked if we had to pay rent to the owners of the public schools and hospitals and public schools to which we send our children. But in a way, this is already what we are doing, because when you have a lot of public debt, in effect, you can end up paying interest payment which are higher than what you will pay in rent. So this is a bit more abstract because this takes place through the financial system, financial intermediation, but in the end, this has very concrete consequences for how much you can invest in the future. Now, regarding wealth inequality, there is a last factor I want to mention, which is the gap between the rate of return and the growth rate, which was relatively high in the 19th century up until World War I, which was reduced a lot during the 20th century, largely because of destruction and important progressive taxation of income and wealth, to the extent that rate of return, in particular for very high wealth portfolio, will be higher in the 21st century, then this might lead to higher wealth inequality. So, of course, there are other factors, but this is something that needs to be considered. And to me, the main implication is that we should have more transparency about wealth in order to adapt our policy, and in particular our tax system, to whatever is going on. So, what is going on? We don't know very well. Let me show you some data. If you use the billionaire rankings that are published by magazines, and so on this table I use the Forbes rankings of billionaires, which started in 1987, where they rank all billionaires in the world. Let me make clear that this data is certainly not perfectly reliable, and I am a bit ashamed to show you this data, but on the other hand, it's probably higher quality, at least for the top of the distribution, that what you have in the public statistics and the public wealth surveys that are based on self-reporting and on which you have basically nobody at the very top of the distribution, which is not very plausible either. So I think the billionaire rankings published by magazines are a bit more reliable, at least for the top. So let's see what we can learn from there. What we can see is that the average wealth at the top if you took the very top percentile of the world distribution of wealth, have increased at 6 to 7% per year over this time period, which is 3 to 4 times faster than average income, average wealth in the world, which of course cannot continue forever. Because if this was to continue forever, the share of world wealth going to billionaires will go toward 100%, which everybody would argue will be too much. And I'm not saying it will go to 100%. I am sure it will stop before that. But where will it stop exactly? Nobody knows. And this can go very fast if you have this kind of divergent process going on. Why is this going on? I think there are many different factors. There were lots of privatization over this period. So you have lots of top billionaires like Carlos Slim in Mexico or Russian billionaires. They did not invent oil fields or gas fields or telecom sector in Mexico. They just became the private owners of public assets at very low prices. So the good news is that there is not much left to privatize. So this should not continue for too long. Now, the other factor is, I think, the existence of scale effects in portfolio investment. So, when we talk about R, the rate of return to capital, not everybody gets the same R. So, to illustrate this, here I show you returns to US university endowments. So I'm not doing that to depress people in public universities with no capital endowments, but just because at least these people publish data. So, US universities, they publish detailed portfolio, so we know what they do with their money, we know why they get the returns they get, which we don't know for the Forbes people. So here at least we know a little bit more what's going on. What you can see is that they are doing very well. These are net return, net of inflation, net of all management fees, etc. So this is really the pure return to capital that you get over this period. So clearly, US universities are not investing in US treasury bonds. I don't know. So they are investing in very sophisticated financial assets, financial derivatives, commodity derivatives, unlisted companies. And you can see that the higher the initial endowment, the higher the return, probably because it takes a lot of expertise to be able to invest in these assets, and you need to have a very large portfolio for it to be worthwhile to buy all this expertise. So if you take the case of Harvard, right now they have an endowment of $40 billion. So they spend only 0.3% per year in management cost, but 0.3% per year of 40 billion is more than 100 million a year. So if you can spend more than 100 million a year to pay for financial advisor, even if these people are very expensive and they are not always right, but if on average it allows you to get a return of 10 rather than 8 or 6, it's worth paying 0.3% per year. Now, if you have an endowment of 100 million, you're not going to spend 100 million a year in management fees. And if you have 100,000 Canadian dollars on your bank account, you can ask advice to your brother-in-law, but probably that's not going to get you very far. So I think it's important to put, in the textbook economic model, the rate of return to capital is supposed to be the same for everyone. You go to your bank and the next morning your 100,000 Canadian dollars get invested in China to the world best rate of return. But this doesn't work like this. And in particular, financial deregulation, if anything, seems to have increased inequality in access to good financial returns, with some people getting very high return, some people getting close to zero return. So this is an important factor. Part of the regulation could come from more progressive taxation. Let me simply say that, some people say that more progressive taxation of income and wealth will never happen in the future. I am not very impressed by these kind of statements because, the history of taxation is complicated and is unpredictable. And many people 100 years ago would have said that the income tax would never happen. And in the end, well, it happened. And you can see that in the US and in the UK, in particular in the US, the top marginal tax rate between 1930 and 1980 was 92%, which apparently did not destroy US capitalism. And if anything, productivity growth rate over this time period, before Reagan, were higher than what they have been since 1980. So probably the reason why is because at this very top this very high top income tax rate only apply to very, very high incomes, say above $1 million per year. And the evidence seems to be that it's not really worth paying top managers, $10 million rather than one. And that's probably the reason why it didn't have much impact on growth. You have the same evolution if you look at top inheritance tax rate. So I know that in Australia, right now, the top inheritance tax rate is 0%, which is really quite small for a tax rate. You can see that in these 4 countries, US, UK, Germany, France, it's about 40%. I could have put also Japan, which just increased its top inheritance tax rate from 45 to 55%. This was done by a right-wing government, by the way. So it's important to have this in mind. For a very long time in the US, in the UK, it was 70, 80%. In France and Germany, it never went that far, partly because the redistribution was done through destruction, through the war, through inflation. And I think progressive taxation is a much better way to redistribute wealth. Let me conclude by coming back to what I said at the beginning about the need to open more data sources on emerging countries and to go beyond this historical experience with developed countries. So we now, partly due to the success of the book, we now have access to more data. In particular, we have newly accessible fiscal data in South Africa, Brazil, Middle East, some Middle East countries, India, China. And all this work suggests that official measures of inequality in these countries vastly underestimate inequality. And if we look at the case of South Africa is interesting. If you look at the top 1% share, it's a bit higher than in the US. If you look at the top 10% share, it's a lot higher than in the US. Of course, this corresponds to a situation where in South Africa, you have roughly 10% of the population that is white and 90% that is black, and that has been a very, very, lot of inequality historically. If you look in Brazil, you also see that with the fiscal data, we find a much higher inequality level than with the official survey data based on self-reported information. So according to the official measures, Brazil is less unequal than the US, but according to the fiscal data we had access to, it's actually more unequal. It is even clearer for the top 10% share, where it actually went up to over 55% in the latest data point. In the end, you can see the difference it makes. According to the official survey data, inequality was reduced in Brazil since the 1980s, 1990s. But according to the tax data that we have, it actually increased in the recent period. But before 2006, actually, we don't know because we couldn't have access to the fiscal data before 2006. So you see that the evaluation we make of what has been going on in a country like Brazil in recent decades in terms of inequality is very different depending on whether we have access to higher quality data. Generally speaking, I should say that extreme inequality in the world, like in South Africa or Brazil, is very often associated with a very strong historical legacy of racial discrimination or rigid inequality of status. So if you take South Africa, you had apartheid until 1994, which meant no right or restricted right to property or mobility for 90% of the population. So the black population from 1910 to 1990, they had to stay in particular areas. They could not own any property in the rest of the country. And there was no redistribution after the end of apartheid. There was no land reform, which you had in the past in a number of countries in Asia or in Europe or in different parts of the world. There was nothing like this in South Africa, and that's probably part of the reason why inequality did not change that much. Brazil is a country which has also a very strong legacy with racial discrimination. It's the last country in the world that abolished slavery in 1887, and at that time, 1/3 of the population was slaves. So you come from, and in the US, in the south of the US, 40% of the population was slave until the 1860s, and you had legal racial discrimination until the 1960s. So this certainly accounts for the strong level of inequality that you find in these countries. But there are exceptions, and I would like to conclude with this. In particular, the Middle East, if we compare different regions of the world, this is the region so far where we find the highest level of inequality. due to different factors, but the most important factors is the very strong geographical concentration of oil resources with very arbitrary frontiers, with a lot of oil resources in territories with very small population and no oil resources in territories with much larger population. Also the role of sovereign wealth funds in oil countries in order to transform the initial oil rent into a perpetual financial rent is of course playing a very important role. So in the end, it's quite striking that oil and finance can be more powerful inequality-generating mechanisms than slavery and racial discrimination, in the sense that you have, in the Middle East, a level of inequality, according to our estimate, which is not only higher than Western Europe or the US, but even higher than in South Africa and Brazil, which is quite striking because in the Middle East you don't have this strong legacy of slavery, heavy racial discrimination. But in the end, these more sort of modern forces related to the oil market and the financial system can be more powerful than these sort of more brutal and traditional forces based on discrimination. And I think modern inequality is really a mixture of all of this. You know, sometimes, in particular in the West, and in particular, if you listen to the winners of the system, you know, they tell you, sort of fairy tale story about inequality, that modern inequality is only about meritocracy and merit and has nothing to do with the bad inequality of the past. But if you look at the world today, you know, it doesn't work like this. You have a combination of forces. Discrimination, racial discrimination plays a role, not only in South Africa and Brazil, but you know, I can tell you in my own country, in France, if you come with a Muslim name on the labor market, you're going to have a very hard time finding a job. So this kind of extreme forces of racial discrimination, racial inequality still play a very important role, not only in emerging countries, but also in the West. You also have these very modern forces related to global financial markets, large concentration of oil resources, which can have huge consequences. So I think we need to put all of these factors together if we want to move beyond this Western illusion about modern inequality, which is supposed to be based on social harmony, equality of rights, meritocracy, as opposed to ancient inequality based upon status, caste, etc. I think meritocracy is largely a myth that has been invented by the winners of the system, and in practice, you know, I have shown you access to education in the US, I have shown you extreme inequality example in the Middle East or in South Africa. This has little to do with meritocracy. There's a lot of discrimination in all post-colonial societies, including, of course, in France. And the kind of debate that we see in India today about reservations and about how to go from a caste-based discrimination system to a parental income-based quota system in order to get more access to education, I think we should not neglect these issues and believe that they are only relevant for, country with very traditional inequality structure like India. I think they are relevant everywhere. So, general conclusion, I know I've been too long and I'm really sorry about this. The history of inequality is deeply political. Wars and revolution played a key role in the 20th century. Let's try to do better in the 21st century. You know, I am an optimistic person. You know, I believe in peaceful evolution. I believe that the democratization of economic knowledge and the public discussion about these issues can contribute to help to a democratization of society and to reduce inequality through peaceful means. But we need to be aware of this legacy. In a way, both Marx and Kuznets were wrong in the sense that, you know, Marx believed in ever-rising inequality is inevitable until final revolution. Kuznets believed in a natural decline of inequality in advanced stages of capitalism. I believe that there are powerful forces pushing in every direction, and in the end, which one dominates really depends on the institution and policies that different societies choose to adopt. The ideal solution, well, there's no ideal solution. You know, it's a combination of policy, progressive taxation, education, economic democracy. Probably the main conclusion is that inequality regimes need to be put in a broad historical and comparative perspective. Every country tends to believe to be unique. I can tell you in France, this is true certainly in the US, certainly in China, maybe also in Australia. People believe that they have a unique historical experience, that there is nothing they can learn from the experience of other countries. But I think this is always wrong. I think there are always alternatives. This is what we learn from history. There are different ways to solve this problem. And, I hope I have convinced you that there's a lot to learn from looking at this different historical experience. So thanks a lot for your attention.